In this video, I will discuss what most people get wrong when it comes to inflation and the money creation. This is the velocity of money. What is the velocity of money, you might be asking? The velocity of money refers to the speed at which money circulates within an economy. When the rate of money is high, businesses and individuals are spending more, and money is changing hands frequently. However, when the velocity of money is low, people and businesses are not spending much, and money is not changing hands frequently. There has been concern in recent years about the velocity of money being low in the United States. This is partly because the Federal Reserve has expanded its balance sheet since the 2008 financial crisis. Some economists and policymakers are concerned that this Fed's balance sheet expansion will lead to inflation. However, in this video, we will argue that the low velocity of money and the expansion of the Fed's balance sheet will not cause inflation. First, it is important to note that inflation occurs when there is too much demand for goods and services and insufficient supply. When demand is high, but supply is low, prices increase, leading to inflation. However, there is not much demand for goods and services in the current economic environment, despite the Fed's balance sheet expansion. The COVID-19 pandemic has significantly affected the economy, with businesses closing down and people losing their jobs. This has led to a decrease in demand for goods and services as people and businesses are trying to save money. With low demand, prices are not pressured to increase, even if the Fed's balance sheet is expanding. Second, the low velocity of money means there is not much circulation within the economy. People and businesses are not spending much, and money is not changing hands frequently. When the velocity of money is low, prices are less pressured to increase, even if the money supply is expanding. The low velocity of money has been a concern for policymakers because it can lead to a stagnant economy. However, in the current economic environment, inflation is not a concern because there is not much demand for goods and services. Third, the Fed's balance sheet expansion is not necessarily inflationary in the short run. The Fed has expanded its balance sheet since the 2008 financial crisis to stimulate the economy. This involves purchasing assets such as treasury bonds and mortgage-backed securities. By doing so, the Fed injects money into the economy, which can increase liquidity and stimulate lending. However, this does not necessarily lead to inflation in the short run because the money the Fed injected does not enter the real economy. Unlike, for example, stimulus checks, this money was entering into the real economy. Japan has been seen as an example of an economy in which printing money does not necessarily lead to inflation. This phenomenon has perplexed economists worldwide, as it seems to challenge the traditional economic theory that links an increase in the money supply to a rise in inflation. In this essay, we will explore the reasons why Japan has managed to avoid inflationary pressures despite its numerous quantitative easing programs, which have resulted in the printing of vast amounts of money. To understand why Japan has not seen inflation, examining the historical and economic context in which the country's monetary policies have been implemented is essential. Japan has been trying to boost its economy since the early 1990s, following a prolonged period of stagnation that lasted for over a decade. The decade of the 90s was a period of deflation that remains to this day. The Japanese economy faced numerous structural challenges that impeded its ability to grow and flourish, and deflationary pressures were the norm as the price level continuously declined. To overcome this problem, the Bank of Japan needed to pursue unconventional monetary policies, such as quantitative easing, to increase the country's money supply and revitalize credit demand. The Bank of Japan started experimenting with quantitative easing in the early 2000s, which entailed purchasing large amounts of government bonds to boost liquidity in the financial system. However, this policy had little effect on the real economy, and deflation persisted. In response, the Bank of Japan increased the scope and scale of its quantitative easing programs. Since 2010, the Bank of Japan has engaged in several rounds of asset purchases, creating trillions of yen. Despite this unprecedented expansion of the money supply, inflation remained low. The annual rate has stayed below 2% since 2011, raising questions about whether Japan served as an example of printing money without leading to inflation.